Testing, testing, 1, 2, 1, 2. Hi, everyone. Thank you all so much for coming out to our lovely event. I want to start first and foremost by thanking the lovely Tartine staff for hosting us and providing all the amenities. I also want to thank our sponsors, Deloitte and First Republic Bank, for helping us put together this event and the attendees. And a shout out to my tireless teammates, Thea in the blue blazer back there and Andy in the blue blazer back there. Please talk to them and thank them for all the hard work they put in on this as well. So, I'm Chris, also part of the OCV team, but we're not the stars of the show. I think you guys came to see Minnie and Hemi. So I want to introduce Minnie, who gracefully is hosting us. Minnie is from 10110, an LA-based firm investing in AI, software, and technologies at the early stages. And Minnie is the star also of the LA Venture podcast, which I am an avid listener of, interviewing all the cool VCs all across the US and probably globally at this point. But prior to that, was the founder of Shift, a used car rental company, as well as a computer science major from Stanford and an early PM at Google. And at that, I'll leave it to them.
Thank you. I'm very excited about the chance to talk to Hemi today. Hemi is not afraid of talking, but you don't have a lot of podcasts out there. You don't have a lot of material out there. So it's a real treat to get to interview Hemi today. For those of you who don't know Hemi, he is the managing partner of OCV. They are an LA-based fund investing in software and healthcare. OCV closed their first fund in 2018. They've made 17 investments across North America and Israel with 5 exits, most notably Invoice2Go, which was acquired by Bill.com for $625 million. What we're going to spend some time talking about is Hemi's career prior to OCV. Hemi was the CEO and co-founder of J2. He holds the record for the most acquisitions by a single public company CEO. He grew J2 to over $1 billion in revenue by acquiring 165 companies during his tenure. J2 was the second biggest public tech company in LA and the largest market cap company run by an Israeli. Those are huge accomplishments, like $1 billion in revenue. I thought it'd be useful and relevant to talk some about your background at J2. A lot of investors here want to know, how do I grow a company to $1 billion in revenue? So I thought we'd start there.
Hi, everybody. I do speak, but not all a lot. I try to keep myself rare, so it'll be more unique. And as a public company, I was like 80 times on earning calls, so I had enough. I took a break. It's the first time ever that I have whiskey with me while I'm talking, so
yeah.
Let's drink it. Actually, 29 years ago, I was brought here by Motorola. I was working for them. I thought that, if you want to be successful, go to America, the land of opportunity. And I realized very fast that Motorola is not an opportunity. And instead of going home, I was looking to do something more entrepreneurial, and I started to look, and I found a company called JFax, 2 guys with an idea, fax to email. It was the .boom area. Tonight I think I will talk a lot about crises, because when you are in a crisis, you suffer, but after it, especially me, I enjoy it because I look back, and usually if you're smart enough and you focus on it, you get out of the crisis better than you started. So now there is a crisis. All of you that are, suffering, you'll have a great opportunity to do better. So backwards, I joined the company with an idea, became the co-founder, and we became a company called JFax, fax to email. It was then a dying industry, but it's still big. And through my process, they took me because I was, good in raising money, and I met through a common friend, a guy named Richard Dressler. He's not here, but he's, my partner. And he wanted me to work with him for a company that does software for hotels. It was super boring, and I gave him a demo of the product. And that night we called my other partners, and he said, tomorrow I'll come, gave us $7.5 million. His condition was that we move to LA. So here we are, I'm in LA, moved here in 97. And in 99, took the company public. I was then the CFO, he was the CEO. And now this is something you should listen to, all of those that do VC. The company revenue was $3.5 million, and we raised 80. Today it's a startup. It's not even a good startup, it's like a small startup. That time, it was an IPO. Yeah, not dissimilar to what we have seen with the SPACs. But this was basically symbolizing to us that the crisis is coming. When you go public with $3.5 million revenue, and your burn rate was like $2-3 million a month, and we had no clue what we are doing. We had no clue what we are doing, zero. But we raised money and we went public, and then guess what happened? Sometimes in 2000, our stock went from like $10 to 23 cents. It was an opportunity for me, this crisis, because the CFO becomes the most important person in a situation like that. And we were basically starting to provide on a daily basis how many months of money we have in the company. It was a great opportunity for us because there was another company called eFax. They did exactly the same. Think about the catastrophe. They are giving away for free what we are selling for $12.50. Just imagine that you're competing with a company with better name. The one thing that they didn't have is cash. So when you don't have cash and you're struggling like all those startups, you're looking for somebody who will give you money. Nobody will give them money, only us. Why? Because we thought that we can take their asset, their customers, as collateral. We were the only one in the world that will take their asset as collateral. We gave a $5 million as a loan, another $1 million they crashed, and we bought them for a song. At that time, we bought a company from Santa Barbara and Menlo Park that had like over 1 million free customers basically buying the same thing that we are selling for $12.50. We were our fourth CEO, and this is something I didn't tell many people. I was actually fired at the end of 2000 because I refused to continue and sign checks. We would sign every month a check. The older guy people know AOL. AOL, if you wanted to go public in these times, if you have a contract, exclusive contract with AOL, that they promote only you as the fax to email, and we had Yahoo also, you can go public. So basically, I started to refuse to send the checks for those guys because I find loopholes in the contract that they're really not living up to their... So I was fired, but not really fired. The guy who fired me lost his job, and I became focused on monetizing the free customers. If you ever want to talk about free customers, catch me on the side. The one thing that people don't understand in free customers, that they are paying you. I will ask a question. Who knows what are free customers paying you with?
Data?
No, the time. They spend time on your product. If somebody spends time on your product, he's paying you. You will make money. So basically, I will cut it a little short, but 6 months later, we converted significant amount of their customers to paid customers. We became cash flow positive. And here we are, the largest fax to email company at the time, not a big title to have, but this is it, And, and we were making so much money that we fell in love with M&A. So, wow, we integrated the company, we know what to do, we made a lot of money. Our stock was still depressed, but I was also at the time, something that I take a lot of pride, my title was CFO and CMO. And, the search engine at the time was something called Alta Vista. I don't know if you remember. I would once a week do a search, CFO and CMO. I was the only one. There was nobody. It was CFO and CMO. I was, I guess, not good in either of them, but good enough. And basically, company grew very well. And I was the CEO up to 2017. and then I joined my first investor, Richard Ressler, to become a partner with OCV.
I looked at the track record and at like there were a number of years where you were acquiring over 20 companies a year, right? So you fell in love with M&A.
Absolutely.
But I just want to understand more about the M&A. Like, were you doing it because you were acquiring revenue, or were you acquiring customers, or how did you build this whole M&A machine?
Amazing question. So there are more superlative to come. That's just an amazing question. So
he told me there's like a coding for what he says.
Yeah.
An excellent question is different than a very good question, but I don't remember the difference.
Yeah. So a very good question is a question that you ask. I know the answer is very good.
This was an amazing question, though, if I remember correctly.
We started to look around and find our way out of this depressed valuation, because when you are a fax company, never mind that you're making profit, never mind that you're growing, never mind that you make cash flow, everybody's telling you fax is dying. Just as a comment, a side comment, J2 Global broke into two companies, Ziff Davis and Consensus. Consensus is still the old fax company. The revenue is $350 million, and you won't believe it, they are still growing. The reason that they are growing is they are focusing on compliance in healthcare, but they are still growing. The stock tumbled last month to 30, and I'm very happy that I bought some. They are now at 37. So anyways, going back, so basically, we started to look around and saw that in 2000, there was what I would call a perfect crisis. A lot of the competitors were running out of money, and those that failed to change direction fast enough, we have here a lot of VCs, you have companies, it takes them a while to understand, to the older guys, to basically, many VCs, many CEOs are young, and the team is sometimes even younger, and they just think that they will continue to do what they can, they will raise money, and they will survive it. We, thanks to, a lot of advice that were given to us, figured out that the best thing to do is, instead of spending all this money on marketing and search and everything, we'll just go and buy those companies that burned all the money in search. We have our business was subscription. So everybody who spent money on acquiring companies, they had many problems. First of all, the churn was much bigger, because in crisis you cancel whatever you don't need. Secondly, the competition, was acquiring was, people don't have, the demand is not there. And then you cannot raise money also, because the VCs are asking you, about your metrics, and they look horrible. So what we did at the time, we decided that the cash we do, we just go and acquire company. Now, acquiring companies is not easy if you're not methodological. If you want to acquire companies, if you want to buy, we bought 165 companies.
20 a year.
I probably, 24 1 year. But I personally maybe talked to maybe 1,000 companies to acquire 165. It's a process. You have to have a book of business. You have to meet them again and again. You have to find the seller. Sometimes it's the CEO. Sometimes it's the shareholder. Sometimes it's the board. And you have also to come with a good offer. So eventually, we became a company that is focused on it. Everybody who worked for us was totally into M&A, meaning M&A is not just buying companies. The easiest part is to buy, integrating, executing, bringing the customer that you buy into your platform. You see a lot of companies that buy a lot, but they have like those separate islands. It doesn't make sense. We were always integrating, and the rule was, if you don't give me, or the board, depends on the size of the acquisition, a plan for what you're going to do in the 30, 60, 90, 1 year, if you don't have a good plan and you're not ready to basically rip the bandit or fire everybody that you need in the first day, we will not do it. It's not easy, but we became so good at it that we bought, I don't know exactly how many, but maybe 20 companies without ever seeing them. That's unheard of. We became so good in certain aspects of our business that we'll ask them 4 or 5 questions, give me the answer, We'll give him an offer, like Zillow. Everybody wants to know the value of his house. People don't want to sell the company, but they want to know how much you will pay them. So, of course, sometimes, most of the time, the offer is not high enough. That's okay, but now they're on the book. It's just a matter of when, because they are interested in selling. So we developed that, and we bought so many companies in all the forms. There is the easy one, which is the roll-ups. Roll-up is when you buy a company that is similar to you, and you just take the book of business and put it on your books, basically migrate the customers. The second one was complementary products. That's a bit harder. Basically, you think that the product that you buy will be complementary to what you do. It's not easy, but doable. The next one was when we bought IP. A lot of the way we got so many companies is we served them with the infringement of our patents. Usually we didn't sue them, but it was a very good way to meet. Tell me how many users you have. You don't want to talk with me. What do you mean? You're infringing my patent. So we became, honestly, even though we got this reputation, we had very few lawsuits. The idea was, you are infringing my patent. Most of them would say, we are too small, we are too this, so we'll get data from them, sometimes on a quarterly basis, to know where they stand. And based on that, we will focus our attention in the right companies. And the hardest one to do is when you buy something that is not related to you. So in the summer of, I think 2004 or 5, I was in Israel and I got a call from Merrill Lynch and they said, we want to give you a super cool, cheap loan of $500 million. So I said, I'll come back to you. And I called my Richard and our CFO, and they say exactly, they want to give you money because you don't need money. Negotiate the rate and take it. So now I'm sitting on over $1 billion, still acquisitive, $1 billion.
$1 billion.
$1 billion, of course, bill. $1 billion, super acquisitive, and we really don't have a lot to do with the money because we didn't find good deals. And then came a company called Ziff Davis. Now, Ziff Davis is media. We don't do media.
Not yet.
Yes, not yet. But we felt that they have a very good book of pipeline of acquisitions. I will tell you something first time. I think enough years passed. They had a deal to buy a company called IGN. IGN is a big gaming company, content on gaming, that was on the block for a while. When you buy companies, those companies sit on the block for a while. And there is some type of M&A called carve out. Big company wants to carve out an asset. They should not tell you it's a carve out, because if they do, you'll pay very low fees because they want to get rid of it. Carve outs are one of the most difficult M&As because once you buy a small company like us, buying a carve out from a big company, the day you sign the deal, they're done. They take the people, leave. We gave you a good price, go away, basically. So we bought IGN for a price that was so low that we signed a contract that if you will sell it in the next, 10 years, for a penny less than we paid, we'll have to give them the money. So we bought Ziff Davis and then continued with acquisition. And yes, reached a revenue of over $1 billion. And as I told you, I live from crisis to crisis, so I did well in the 2000 crisis. We bought eFax, I became CEO, everything was great. In 2008, we have a huge crisis. We bought like 60 companies with $700 million between 2008 and 2013. This was the period when the stock from 2008 till recovery was 6 years, 5 years till 2013. So we did very well there, and we bought a lot of companies, and this was another crisis that I felt that I did a lot for the company. And then I said, I'm 30 years in the US, 30 years, 3 crises, average of 10, the next crisis is coming. So in 2018, I said, I'm going to leave J2, go with Richard, he's a better businessman than I am, and I'm going to wait for the next crisis and make even more money and more fun. I missed by a mile because it took us instead of 2018, I think now 2023, we're there. So, but I believe that all those crises make you stronger But I kind of, it's said the weak gets weaker and the strong gets stronger. But if you're sitting in the right place, you can enjoy.
I mean, I kind of want to know, where are we now? Where do you think we are now? Like, you've seen other, 2000, 2008, you've seen these things. And also, I'm curious, I don't hear a lot of VCs talking about M&A. It's not like a very common, go-to strategy for most VCs or investors. And so where are we now, and what are the implications for, a Series A, Series B, not a huge company? Like, should they be doing more M&A?
I think that this crisis is similar to both. So 2000 was, overvaluation of startups. 2008 was the subprime crisis. So I think it's an opportunity that the strong companies will merge and buy the weak companies. It's consolidation.
What do you like? What's a reasonable valuations when you're looking at these companies? How are you thinking about?
I have a very unique approach to valuations. There are the regular valuations that you read about in all these, venues. When you are an acquirer, the advantage of the buyer is that he should be able to make a plan. What is he going to do with the company that they acquire? And what will his EBITDA look after he integrates the company? Usually the buyer, not necessarily, EBITDA is higher to start with. And if he's integrating a roll-up, he should be able to do it with basically very few additional employees, because it's integrating into technology, you know what I'm saying? So your EBITDA suddenly will go higher. And you say, okay, my EBITDA now is, I'm valued at 5x EBITDA. Once I will acquire this company, my EBITDA will go from 100 to 180. So what is 5x 180? 900. So you go a multiply of 9. So basically, if you wanted to say it in a different way, the valuation that you do is based on what you are buying and who you are, and what do you believe with your experience of being a good integrator, how will you look post the acquisition?
That's really
so
interesting.
That's the formula
so
that
it's
I
the acquirer.
Use. Yes.
It's the acquirer more than the acquired.
And if somebody offers more, is either stupid or he has better EBITDA or he can do better things with the asset, and you let it go.
But I don't think you, Hemi, are, we know each other a little bit.
Yes.
You don't overpay.
I hear it all the time. And this is an excellent comment.
Great, excellent.
Because,
what does that one mean? Is it very good?
People used to tell us at J2, you are known to be somebody who doesn't pay a lot. I said, look, in all our 165 acquisitions, we came with the best offer, right? So we paid the highest price, so shut up, So it's basically a seller or banker's approach. Oh, those guys will not pay me the full price. And they're right. You should pay them the right price. And I see, and this relates to the question that you just asked, a lot of the startups that I see don't really know how much to pay. And they are led by, FOMO, or the most stupid question I see, how much was invested in this company that you're going to buy? Who the heck cares how much was invested? I care what I will do with the day that I own it. So sometimes they invested a lot of money and you have to write it off. And okay, you know what? In the last 3 days, I was popular, but I became more popular. I'm getting every day a call. Some of them are companies of yours.
Hey.
And of yours too.
Yes.
and they are trying to do deals. And basically, the deal is, who is the buyer, who is the seller, and the opportunity. But I think that M&A now is becoming the daily talk with every startup. If they're strong, and they have money, and they see competitors, and they have their CAC, they say, oh, wow, I can get much better deal if I buy a competitor. It's not only that you buy customers, you also retire a competitor. Now you dominate the market more, you can dictate pricing, you can hire the best people. There's a lot of things when you buy a competitor in a market. The other thing, we don't have money to buy companies. No, you do. Of course you do. If you have a good plan and you have a good deal and you have a good terms, people will fund you. The trick here is some wants to come to me, I want to raise money because I want to do M&A. And no, that's not the way. When you want to raise money for M&A, especially if you have to show the deal. So the investor will analyze the deal, will not analyze just your plan. But so you can raise money, you can find a lot of companies, I'm a VC, like everybody else. Some of the companies, you look at them and say, the best thing for you to do is to be sold. So of course, they're not going to tell, they put for sale sign, but they are. You talk with them, one, two questions, and you know that they're for sale. So now you start to court them. Many times, they will not get your offer. You have to be shy about it. Say, no, when you get an offer, call me, because then you know you have a good starting point. You don't want to be the person that you tell, your beautiful dog is actually a cat, and,
I'm sorry. That one.
Yeah, but basically, it is amazing time to acquire now because everybody is either buying or selling. Very few are stuck in the middle. And there's still a lot of money in the market, but the investors want to fund you to profitability. Not like I want to do round A, round B, round C, right? They want to, and M&A in many, many, many cases is the last check that you write because the merged company is of size, they have direction, and so I think M&A, this is the best time to do acquisitions because I think everybody in a crisis is a little bit less focused on long-term planning. They just try to survive the crisis. And it's perfect time to do M&A, yeah.
I think of M&A usually as sort of a later stage company thing, and yet the company that we have in common is Social Native.
So I invited David to come here. He's the CEO of Social Native. I thought that I will be a little bit more loose when he will be here, when I will tell him about the deal that we did for him. But I think he's a good friend of all of us. He wouldn't mind. This is an example of an M&A that we did together. He was about to buy an asset that was bought by a public company for $160 million. So the price tag was known. You just read in the filing. They bought this shit for $160 million. The revenue was the teens. It was an asset that they bought, and instead of growing, started to shrink. They themselves were acquired by a PE, and the PE, even though they didn't admit it, they wanted to get rid of it. So we identified, and to be transparent, there was a guy that used to work for me at J2 in M&A, and he was the guy that I asked to step in and help David to do the acquisition. So we saw this company. It was a company that was making $14 million, and they failed in the process of selling it, even though they didn't tell us. We found out. So we were the third buyer. So we told them, and now to understand, Social Native doesn't have so much money, but they didn't know. We told them that we are going to buy the company with one-time revenue. So every year we'll give you a quarter of the revenue. In 4 years, we give you 100% of the revenue. Why? Because it's not a great company. And they actually agreed because they said, okay, we'll get some money. And as we talked with them, we discovered that the person that is talking with us is basically misleading us, meaning she's not giving us reliable information. The due diligence, every time we turned the rock, it was worse. So after like 2-3 rounds, when we lowered the price, we walked away from the deal. It was part of the plan to walk away. And then when the deal was dead, I told David, no, this deal is going to happen because they need to get rid of it. We also discovered that they have a few hundred people in Argentina that they didn't know how to fire or get rid of because it's a very socialistic country and it's very costly. And I spent some time with, actually my daughter introduced me to some people that work with her in Argentina. They told us, no, they don't understand how the system goes. Ba-ba-boom, ba-ba-bam. The deal was dead I called the CEO and I said, I will talk with you 3 times, 20 minutes each conversation. We'll do the deal. And indeed, after 3 conversations, we did the deal. The amount that we paid is so small. I really am not going to tell you, but it was really, really nothing. And we were able to, Argentina has high inflation, and you don't have to adjust the salaries. You do it if you want. So basically, by not adjusting the salaries, most of the people left without any cost. It was a very good acquisition.
This story highlights, you said, like, each M&A, each acquisition, it's like a mystery. It's this dance I'm doing.
Yeah, so I speak in schools, or I used to, and murders and acquisition instead of mergers and...
Murders and executions is what you called it.
Murders and execution, sorry, murders and execution. The story here is, there's a lot of...
What a dance, right? What a dancer.
There's a lot of drama in M&A. There is, a lot of stress. Some of the best deals you need to walk away. Some of the deals are hostile. We did some hostile acquisitions with public companies. And I can tell you one thing, every hostile deal ends up being friendly. So most of those companies that we hostilely bought are today true friends of ours. So I really think that the opportunity to do mergers and acquisition now is very big. In our portfolio companies, we already did 5 with our help. And I believe that there are more to come. And I think that's why investing now, even though it's depressed, it's the best time to invest because you can do much more with much less.
Yeah, it's fabulous. And now, it's a unique perspective that you don't hear from all VCs, not just perspective, but unique expertise. And there were so many interesting questions I did not get to ask. So it's okay, though, because we can drink whiskey and then you can ask Hemi about, what was the weirdest M&A you ever did and other exciting things to talk about during the cocktail hour. Is that good?
Thank you very much, guys. Work? Yeah, it's very good, It's excellent. I really welcome you to ask me questions, and I can tell you that I was never excited about investing. I forget to say something. When I left J2, I left hoping that there will be a crisis when I can utilize my long training. This is the time now. This is the time, and all of you, the VCs and everybody, it's amazing. Amazing time to invest, and thank you very much.
Agreed.